Let me know when you are done. Done? Okay, you're done writing. There is a small actually mistake, guys. It is not really a mistake. This is how the textbook says, asset turnover is, they are saying, efficiency indicator. But remember, we have another set of ratios called efficiency indicators, yes? Then you might get confused in the future. How come in the profitability indicators there is an efficiency indicator, right? So textbook says, if you read the textbook, that's how it says, but I change it, right? Profitability indicator. Then in the definition, it says how efficiently the business is using its assets to generate profits. Should be not profit, sales. Okay. So asset turnover, guys. Now so far, right? If you recall your memory, when we calculate the profitability indicators, most of them, how did we calculate? As a percentage, yes. But this one, in terms of number of times, right? Number of times. Okay. So this calculates how many times the total assets have been converted into sales rather than net sales. Okay. What would you say, guys, in terms of the value? Greater the better or lower the better? Greater the better, yes. Why? Because the more times the business can spin its total assets into sales, more profits they will generate, yes. More times they do it, they will convert they will generate profits, yes, right? But there is an exception, guys. In the textbook also, they haven't indicated it, but I'm just telling you for your information, right? we can't say always greater the better, there is an exception. The exception is that, right, if the business makes a larger proportion of this net sales on credit, then there will be a problem. Why? Meaning, business is generating a lot of credit sales. In case one of their major accounts receivable go bankrupt, then there will be a higher chance that the business, this particular business also go on bankrupt. That's the problem. Why? Because they have made a lot of sales, right, on credit in such a way that they can't control it, right? Because many times than their normal assets, they have sold. Yes, they have sold a lot of inventory on credit. So that means if they can't recover a considerable amount of money, that means this business also may go bankrupt. So just have that in mind, right? Apart from that, it's always greater. Right? And also, guys, see, this one you can say usually in the study design says number of times. Otherwise, you can say, right? You can calculate in terms of dollars as well, right? For every, remember an interpretation, right? The numerator denominator combination. For every dollar of total assets, how much of net sales is there? Yes. If you want, you can say number of times, or else how much of net sales is there for every dollar of assets. Yep. Makes sense? Okay, guys. Then the other one, comparison between asset turnover and the return on assets. Right. So comparison, guys. What do you mean by comparison? Compare. Similarities and differences, both, or just similarities? Both. Yes, similarities means both. Compare means both of them. Contrast means just difference. Contrast means just difference. Okay, guys. Right now, similarity between these two. What is it? Asset turnover, ATU. Right. This is another ATU. I can tell you. What is our acronym here? ATO, not the tax office, okay? Usually we know ATO is tax office, but this one, don't confuse with the tax office, okay?
Then in the response, are we not allowed to shorten it to ATO?
No, you can shorten it, don't worry. Okay. As long as you predefine it.
What if you have to talk about the ATO and this ATO?
Yeah, then you have to say ATO 1 or 2, whatever it is. But don't worry, like these two will don't come across together. Right? Yeah, but ATO, every acronym what you have to do, you have to predefine, yes? Otherwise you can't use acronym. Okay? Okay, guys. Now, this comparison, okay? Comparison is firstly, similarity. What is the similarity between ATO and ROA? Yes, anybody remembers? What is ROA, guys? Now, return on assets. What is it? How do you measure it? Now, remember the net sales issue?
Which one?
Net profit?
Which one?
ROA.
Net profit over average total assets.
Yes, correct. Remember I told you, return means always, what do you use? If you have the term return, what do you use? I have told you, net profit, yes? We use the net profit, yes? Right, return. Remember I have told you, right? I think somebody has remembered, right? Okay, so net profit over assets, yes? The asset turnover, net sales over average total assets, yes? Same denominator, guys, but different numerators, yes? Right? So basically, yeah, we are saying, guys, both of them we assess based on the total assets, average total assets. Whereas the difference is what? Difference is that the ROA we calculate we assess the profit, but ATO, what do we assess? Net sales. What's the difference between profit and net sales? Is there a difference?
Yeah.
Or they are the same? What's the difference?
Take away the expenses.
Yes, expenses, guys. Right? What's the difference? Basically, the difference is Yeah, net sales you have, you have it with expenses, yes, whereas profit, you don't have expenses, yes, that's all the difference. Okay, theoretically guys, increase in asset turnover, what is increase in asset turnover means? Our ability to generate revenue in the business is increasing. That means we are using our assets very effectively, efficiently, productively to generate sales, yes. That means like when our ability to generate revenue increases, theoretically what does it mean? It should mean that our net profit also should increase, yes. Yeah? Don't you feel it? Yes. However, guys, that is not the case always, right? So just or merely increasing the net sales doesn't mean that necessarily we are increasing net profit. Why? Because maybe we are increasing our net sales by a lower markup. We have dropped our selling price, right? So as a result, averagely we are generating less net profit, less profit. As a result, our profitability is dropping, right? Otherwise, compared to the increase in the sales, our other expenses also increasing, right? Maybe to deal with the high volume of sales, we need more labor, we need more space. So as a result, we pay a higher rent, right? So things like that we might have, right? However, guys, theoretically, remember, increase in ATO means it should increase the ROE as well. Basically, that's it for the first part. The other one, benchmarks, benchmarks, you should define the normal benchmarks.
Wait, why is ROA expressed as a percentage? The asset turnover, a number of times? Why can't it just be the same thing?
Yes, actually that's a good question. Asset turnover, actually, we can calculate asset turnover. If you want, we can calculate it as a percentage, right? But like when I was at your level, I calculated it using number of days. Okay, if you flip it, right? If you flip that, right, and times by 365, we will calculate it number of days, right? However, to answer your question, Pranav, this one, I would say in this way, it gives a better measurement or indicator rather than using a percentage. Right? That's why we calculate it in number of times, right? Either we can say number of times or in dollars, right? The point is that rather than a percentage, it gives us an indication how well we convert our assets into sales, right? That's why we don't express it as a percentage.
Yeah.
So we can, as I told you, we calculated in number of days as well, right? So that means it gives us how often in a year, we can convert our total assets into sales. How fast we can do that.
Yep.
Right? Yes.
Is there any implications if it's too high?
Yes, implications too high, correct. There is. Why? Because sometimes it can see, so like it is quite similar to what we did in inventory turnover. Why? Because it might say that our selling price is too low, that's why we are making too many, conversions of assets into sales. Right? Yes. The other one is credit sales. If we are making a lot of credit sales, again, it can be detrimental to the business. Right? Okay, guys. Shall we go to the question number 2? Did you do number 2? Did you? Yeah, you can do guys part A and B. The rest, of course, I'll give you the answers. Harry, you have to do the question. Question number 2.
Yes, it's copied now.
Yeah, you have to go. You have to copy later. You can't copy now. ROA. Okay. The other thing, guys, I think all of you who are coming to these classes have been added to my online class. Okay. I think you were registered, yes, last week. Yeah, you were there. Others, I saw all of you have been added. So hereafter, guys, we'll use that platform. Okay. Pranav, did you get the marks for your set?
No, not yet.
Okay.
We'll get it back when we're at this, when we go back to school.
Really? So teacher doesn't put it on the web,
On
the
web.
online?
No.
No?
He only gives you a hard copy.
Really?
Yeah.
Ah.
So you talk about the business management side.
Yeah.
Yeah. We'll only give it back when we go back to school.
Okay. Did you do part B?
Yeah.
What was it?
10% for Beatles and 8% for me.
You want to try part C? You get it? Okay. What the answers?
I need it.
Yeah. Definition I gave you at the beginning of the ATO. Yeah, that's all. That's the definition. ATO. What we just did today. And is it RO?
Yeah.
Ah, okay, sorry.
And it's
Okay.
10% for Beatles and 8% for bottom, right?
Yeah. Everybody got the answer, guys? Krishna, did you get it?
No.
Okay. Did you get it? 10% then?
8%.
sense to be there. Okay.
10%?
Yes, and 10% and the other one is I think 28%.
Oh, yeah.
Yeah. Okay guys, have a look at the answer and also please take down the part C and D. Part C. Right, explain why the ROI, yes. No? Yeah, ROI is higher for Bonium than beetles. Why is that? Yes, so basically they are based on the death ratio, yes? Because, how much is that one? So, ROI in beetles, 15%. Bonium has 30%. So, Bonium's ROI is twice as much as beetles, yes? So, why is it, guys? Because Bonium's death ratio is, what is it? Higher, 73%, yes?
Double.
More than double, yes? Right? So, then as a result, but the net profit is the same. So, as a result, they are making as twice as much of beetles ROI, yes? So Bonium is having a higher return on owner's investment, right? So guys, why I am giving you the theory answers for this question is because you guys should be writing in the same standard. Okay? This is basically the BC standard. Now, still we have more time, but you should be able to be in that standard. So then it's easier for us next year, yes? So I don't have to really improve your writing skills. But you have to practice it, guys.
Definition is total liability to total loss.
Hmm. Yep.
What's ROI?
ROI, what is ROI? Tell me.
Net profit over average capital.
Yes.
lower profit? What's that?
Because more profitable in terms of manager's point of view. Why is that? Because you are not there, yes? Manager's point of view, actually, ROA is, ROI is just for the owner's profitability, but the other one is overall profitability, right? Firstly, Krishan, you complete the tute, and after that, read it, and then I can explain it to you, right? So you are not there last week, yep. Because manager should be able to manager should be able to cover manager should be able to cover not only the owner's investment but also the borrowed money as well. For the borrowed money, we have to service it through the interest payments, right? So then not only the owner's capital, but we have to cover up the debt capital, the borrowed funds as well. So that's why. So manager is responsible not only for the owner, also for the lenders. That's why we say manager's perspective. Right? So ROA, we evaluate the profitability of the business, assessing the net profit based on the total assets. But ROI, we evaluate the profitability only for the owner's capital, right? But return on assets, we assess the profitability based on the total assets, right? So ROI, basically owner is really interested in what it is getting as its return, but manager should be able to take care of both the owner and the lenders. Okay guys, if you are done with this part, you can start question 3. Which is the last question, yes? Concept. Can you see?
Yeah, I can see.
What are you guys doing for accountants too?
I think we're up to depreciation. Are we up to depreciation?
Preschool?
Yeah.
Yeah, depreciation also.
Yeah.
And asset register.
And I said,
Register.
you started depreciation?
Yeah.
Yeah.
What is that? Yeah, question. Yeah, start the question. Should you have any questions with question number 3, tell me.
Do we round percentage
Yep.
to the uniform number?
Yep.
Same question, yeah, you wrote it assesses how effective, but you said to write profits. Wait. Yeah.
Okay, what is the question?
No, the question was, you said to write profitability, but, no.
No.
So,
Right.
no, I answered my own question.
Okay, that's good.
Mr. Arnold, when you answer a question, for example, like state what measures assets turnover. Do you have to say assets turnover brackets 80?
Yeah.
80 or
Yeah, if you are going to refer to a asset turnover and you don't want to write the full term, then you can say within brackets the first time that you write asset turnover,
So
within
then-
brackets you are writing 80.
So then if you have to ever refer it again in this
Yes.
question, you don't have. Also, do you have, like, can you say, instead of saying assets turnover, can you start with assessing? Or do I have to state that?
Yes, you have to state.
You have to
Yeah,
state
yeah,
it.
you have to state. Yeah, otherwise, we don't know what you are talking about. Yes, examiners don't know.
Okay.
Yeah, but basically, yeah, try to write it like that.
Okay.
Yeah. It makes sense, but so we have to write subject, verb, object, yes, so then in that format write it.
So, what does assertion mean?
Assess?
Assertion.
Assertion. Assertion means like a statement.
No,
Yeah.
for the asset turnover, how many places do you round it to?
You round it to the whole number.
Oh, so I just round this to 1.
Which one?
Just that to 1.
Yeah, 1 point. You have 1.475, yes. Then make it 1.5 then.
Oh.
For part B, guys, please leave it to 1 decimal place, because it doesn't make sense that we are rounding up. Yes, make it 1 point, like for 1 decimal place. Always, guys, write the formula when you calculate the ratios. Okay.
Can I go to the restroom?
No. guys, now let's discuss this one. Right? Everyone please stop writing. Yeah, let's discuss. Now, I think all of you are okay with these calculations, right? Any questions with this? Okay. Now you have to tell me, right, the first theory question, I mean the part A is actually pretty straightforward, so you don't have to really worry about it. Right. Part C, explain why ATO has changed from 24 to 25. What do you think, guys? Now this is where we are going to what? We are analyzing, yes? What is analyzing?
Detailed examination.
Detailed examination, very good. Then after that, the other one is what? Having analyzed, what do we do?
Compare.
Sorry? Compare? Okay, what else? Having analyzed, what do you do? Yeah, having compared, after that, what do you do? Discuss. Oh?
Contrast.
Yes. What do you call it? Interpret. Yes. Interpret, yes. What is interpretation, guys? Yes. What is interpretation? Is detail. In detail, sorry? Yeah, no, that's the analysis first. Detailed examination is analysis, is analysis, analyzing. The other one is interpretation, meaning?
Understand.
Yes. What is interpretation?
Explain.
Explain, yes, describe. Right? You explain. Right. Then, why do you think, guys, the asset turnover has, what has happened to the asset turnover? Improved, yes, over the 25th, over the 25, it has improved. Not much, but it has improved. Okay? Then, why is that?
Increase in net sales.
Increase in net sales? Right. What else? I can see the total, sorry?
Increase in sales revenue.
Increase in sales revenue. Also, I can see the total assets also increase. Then,
That decreases it by a little bit, but
which one has decreased?
the average total assets increase. That decreases the asset turnover.
Yes, ability of the business.
Yeah,
Yes, to
but-
generate. Yes,
But they've
yes.
had enough net sales, so that still increases.
Yes. Why is it that, guys? Any other answers?
The increase in net sales was like increased at a higher rate.
Has higher rate than that of the
average total.
average total assets. Correct. See, have a look at, guys. 300,000, like sales return is pretty much the same, right? 300,000 became 448, meaning as a percentage, what? Close to.
Half.
Yes, close to 50%, yes, somewhere around maybe 49% if you calculate it,
Yeah,
right? 49%, yes, so it has increased by 49%. But what is that of total assets, right? It has increased by how much? 40%, yes, 40%, right? So basically, the increase in sales or net sales is higher than that of average total assets. Okay, we'll write it. Okay, guys, next one. Part D. Yep. What do you think about part D? Yep. Referring to ATO and ROA, explain why the owner's assertion is incorrect. What is owner's assertion? Anyway, guys, you know, if the owner says something, it is always. Do you think about the owner of the business? Pretty dumb, yes? Always owners, if owner says something, always correct. Always incorrect, actually. Right? Okay. Owner is saying that expense control has improved in 25 because net profit increased. Okay. Do you agree with that? As practicing accountants, yes? And you agree with that? Net profit has a net profit increase. Yep. What happened to the net profit, guys? Yes, increased, yes?
Yeah.
By about how much? Maybe 10% or more than 10%? 1800 divided by 15, 12%, yes? Yeah, it has improved by 12%, right? See, 15,000 became 16,800. Okay, improved by 12%. Yeah. So that means net owner is correct. Is the owner correct? Net profit increase. As a result, he is saying that expense control has improved. You think so? Expense control improved?
No.
No. Very good. Why is that?
Because the average total assets increased.
Average total assets improved. Okay, yes, comparatively, yes. Average total assets increased, but net profit has an increase in that magnitude, yes?
The
In
net
that
profit
level.
the net profit has increased at a lower rate than the average total assets.
Average total assets, very good. What else? Yeah, so then you guys are looking at the ROA, yes? You can look at another perspective. What is it? ATO, yes? While looking at the ATO, what would you say? Yes. Yeah, ATO we can say clearly, what is it? ATO has improved, yes? That means their ability of the business to generate sales revenue has improved, right? But you think expense control has improved? No. Why not, guys? Because see, they have increased their, we said that, they increased their sales by 50%. But look at the increase in the net profit, just 12%. Right? Pretty bad, yes, their expense control. Yeah? And also ROA, what has happened to ROA, guys? See? 7.5 became 6%. Now see, remember we said that ROA, we are evaluating the business's ability to generate profits compared to their assets. And on the other hand, guys, their ability to generate sales compared to their assets has improved, right? But still, their ROA has dropped. Remember what we did theoretically? Remember what I said that? What is it? In the comparison, see, theoretically, an increase in ATO, meaning increased ability to earn sales revenue, but should mean that increase in ROA and increase in net profit. However, this is not the case always. Right? See, now this is a good example. Why? So our ATO has improved, but the profitability has dropped, guys. See, profitability, ROA has dropped. Right? That means even though they generated more sales, they couldn't retain them as profit. That's why, because their expense control is pretty poor. Then that means owner is the owner correct?
Yeah.
So as we said at the beginning, he's dumb, yes? Owner is dumb, yes? Right. Okay, so we'll say that. I mean, not that part. Right. Okay. Just take down.
showing.
Sorry?
It's not showing.
Oh.
Brandon, how many more cubes are there?
One more.
How is that? Just like 22?
Sorry?
Is 22 the last one? Cube.
No, after that, one more. ETU. Okay guys, what do you think about the last one? Suggest 2 strategies the owner could adopt to improve net profit next year without changing asset turnover.
Decrease expenses.
Decrease expenses without changing asset turnover. So that means which ones you shouldn't change?
Net sales.
Yeah, net sales and total assets you can't touch. Then what else? Yeah, expenses. Which expenses? You have to take.
Cost of sales.
Cost of sales. 2 strategies. Yep. Cost of sales.
So cheapest.
Cheaper supplier without compromising the quality. What else?
Rent. So cheaper
Yeah, rent, electricity.
Oh wait, that's an asset.
Wait, what?
No.
Wait,
You
what?
can.
No, wait.
You could say
Huh?
decrease advertising. Actually, no.
Decrease
Yeah, because that could
advertising.
lead to more sales.
Yeah, you can't touch something which is affecting the sales. Oh. Apart from that, you can say wages. Yes, wages you can reduce. How? Maybe.
Isn't that unethical?
I mean, wages you can do it. Yeah, unethical. There is an unethical part. You are correct. But in this case, we don't have really worry about that question. Why? Because if it was an ethical question, then you have to talk about all the possible scenarios. But this one, you don't have to really worry about it. And what we are doing is basically rostering and improving efficiency. Right? Maybe we can train the employees, right? Things like that. And then also you said about something electricity, yes?
Yeah,
You can say reducing utility expenses, right? Okay, but mainly guys, what are the biggest expenses in the business? Yeah, cost of sales. Next one is wages. After that maybe rent, right, and so on. Okay.
What's rostering?
Roster?
Yeah, what is rostering?
Rostering means like, what is it? Basically, employees, you know, the way they work, their schedule. It's a roster.
How does that reduce the wages?
Yes, basically, Harry, we have to roster maybe, you know, employees, like when it is a busy time, yes, of course you have to have more employees, or maybe you'll have to have more efficient employees, right? And then if it is like not that busy, then you can reduce the level of staff, right? And also maybe at that time you can have more unskilled or semi-skilled labor, right? Maybe basically they are cheaper, and then as a result you can reduce the wages, right? So things like that.
Does time count as well, like how long you work as well?
Yes,
So that you could like decrease time?
yes, you can reduce the timing. Yeah, then yeah, so everything is included in rostering, guys. Okay. Okay, that's it for the first part of the profitability tube. Let's start the second one, guys. This one is not connecting, guys. I don't know. I'll dictate the node, guys. This one is not connecting. Right there, net profit margin, NPM, is a profitability indicator that evaluates the expense control by calculating the percentage of net sales that is retained as net profit. Take down the formula, guys. Net profit margin. Did we do net profit margin before? Yes. That means we can do this part faster. Net profit or net sales times by 100. Yep. Net profit margin we calculate as a percentage. NPM calculates how much of net profit Is it because of the bad weather? I don't know. 3, 4, 7. Done. I think guys, up to this one we have done, yes?
Yeah.
And this part we haven't done. Okay, what is it? Relationship between net profit margin, asset turnover and the ROA. Krishan, look at this. Right? Relationship between these three ratios. Right? Okay. Now guys, what is net profit margin? Net profit margin calculates for every dollar of net sales how much of net profit has been earned, yes, in the business, right? And then basically net profit margin evaluates the expense control, right? So what level of net profit has been retained from the total sales that we earn, right? What is the other one, guys? Asset turnover. Asset turnover calculates how effectively we can generate sales in the business. And when we combine these two, what do we get? ROA, return on assets. Why? Because return on assets calculates how effectively the business can make use its assets to generate profit, and also how well they can control their expenses, right? So the return on assets is the outcome of both the two aspects, right? So those two aspects are evaluated from net profit margin, expense control, and then asset turnover, the ability of the business to generate sales, right? That is theoretically, see. Asset turnover measures the ability of the business, yes, that you know. Net profit margin measures the expense control, and when we combine those two, we get the return on assets, guys. And then same thing we can prove it algebraically using formula. Okay? Right? How do we do that, guys? Have a look. Now, return on assets we are going to say is equal to asset turnover times by net profit margin. Right? Now see, asset turnover means what? Net sales over average total assets. Net profit margin means what? Net profit over net sales times by 100. Then what will happen? Net sales will get cancelled with this net sales here. Then what is left behind? What is left over? Basically, guys, this one. We have net profit and we have average total assets and 100. What is this one? Our return on asset, guys. Okay, this is called, what is it? This one was actually invented by one Frenchman, so we call DuPont analysis. Yeah, DuPont analysis. DuPont means I don't know. French. Anybody knows French? Tell me. Right? DuPont means what is it? Is it a name? Yeah. No French?
No.
You know?
He knows French.
No? You know French? Yeah. Okay, guys. Right? Net profit. Or average total assets times by 100. Right? Okay. Are you done with this? Yeah. Before we do, we can do gross profit margin as well because we have done it before. Right. You okay, guys? With the first page, gross profit margin will take down. GPM is a profitability indicator that measures the average markup. By calculating the percentage. Okay guys, right. Out of these two, right, net profit margin is actually pretty straightforward, no confusions. Always I can tell you, greater the net profit margin, higher the profitability. But the other thing is guys, gross profit margin. Gross profit margin is not that straightforward, right? Gross profit margin, what is it? Also a profitability indicator. Now see, we are using the other one is guys, both of them margin. What is the opposite of margin? Markup. Right? Opposite of margin is what? Markup. Why is it? Markup means what? Markup, we compare the gross profit with what?
Net sales.
Markup? No. How do we calculate the markup percentage? We compare the gross profit with cost of sales. Correct. Cost of sales or cost of goods sold. Correct. With the cost. Right? We compare the, yes, that's how we calculate the markup. Yes. We calculate the profit with the COGS or cost of sales. The cost simply. Right? Then margin means what? Margin means guys, we compare always with the net sales. Have a look at this one. Gross profit margin. What is it? Gross profit or net sales? Net profit margin or net profit or net sales. So wherever you come across the concept, what is it? Margin means what? You compare the whatever it is, net profit, gross profit or anything else. You compare it with what? Net?
Sales.
Net sales. Am I clear? Alright? Okay, net sales. Okay, so net profit margin, gross profit margin, we compare with the net sales, right?
Is there one more margin?
Come again?
Is there one more margin?
No, not in your studies, no.
So there is one.
No.
Right now study one.
No, I mean, no, I don't, no. I can't think of any other margin, no. That's it. We have net profit, gross profit margin, right? So then guys, yeah, then with the gross profit margin, remember, the only problem is guys, gross profit margin, remember I told you with the net profit margin, greater the better. But this one, I can't tell you like that. It is not that straightforward. Why? Because guys, gross profit margin, you can improve in two ways. Right? Right? You can improve in two ways. What is it? Either, now, how do you calculate the gross profit actually? How do you calculate gross profit? Tell me. Net sales minus?
Cost of goods sold.
Very good. Net sales minus COGS, yeah. Net sales minus COGS is the gross profit, yes, right. Then, if you want to improve the gross profit margin, right, one thing guys is that you can increase the sales, which means one way is you can increase the selling price, right. The other thing is guys, if you want to improve gross profit, you can drop the
Cost of goods sold.
COGS, cost of goods sold. So that also you have two options. Either you can reduce the cost of sales, you find a cheaper supplier, and the other option is you reduce the buying expenses. Cartage inwards,
Right.
Sorry?
But isn't that just
No. Buying expenses is part of the COGS. It's not a part of the cost of sales.
cost of
Yeah.
goods sold?
Yeah. Right. So then, so you have two options, guys. What is it? Either you increase the selling price or decrease your COGS. So both ways you can improve the GPM. You can improve the GPM. But there's a problem with, reducing the COGS. I don't think anybody will have any issue. Yes. Right. No, nobody will object for that one, yes. But increasing the selling price is, guys, a problem. Why? increase in selling price may not be welcomed by the whom? Customers. However, it doesn't affect all the goods as well. Why? Now, if you guys use an iPhone, every time what do? They increase the selling price, yes? But still what do? I will go and buy. Right? You guys will go and buy, yes, that's the thing, right? iPhone, so I'm just saying an example. You can say any other examples as well, right? They don't really care about, iPhone users, maybe rich people, they don't really care, yes, about the increase in the price. But if it is like, if there's any product, for iPhone, it doesn't matter, okay? So, there is any product that is price conscious by the customers, then the owners of that particular product has to be careful. Okay, because why? Increasing the selling price, guys, can have a lower sales volume. So lower sales volume means what will happen? Gross profit will drop. So as a result, guys, this part is not even in the textbook. I have included this one. See the first one, right? Improving GPM. You can increase the GPM, guys, by increasing the selling price, no problem. However, there's a problem. As long as the gross profit amount increases or remain constant, you can increase the selling price. Otherwise, if the gross profit is going to drop, that means it is not recommended to increase the selling price. Why is that, guys? The point is this one. So let's say we double the selling price or we increase the selling price by 50% in order to improve our GPM. But our customers will not like that. Customers will basically stop buying. Most of the customers will stop buying from us. As a result, what will happen? Our volume also drops by half, right? But if you calculate the GPM, what do you what do you see in the GPM? With increased price, you calculate still the GPM. Where your customers, half of the volume has dropped. But still GPM, what do you think? What do you find? GPM has? Yes? Constant? Constant? Any other answers?
Let's say it again.
Yeah, that means you haven't understood. Okay. Now let's say, okay, now something like this. I'll give you a practical example. Yes. Now let's say, so in our center, we are going to double this tuition fees. Okay, then what do you think will happen? Some people will leave. Yes, will drop. Yes, they will drop out. Price is too high, they can't pay, they will drop out. But still, some people will come, yes? Right? Some people will still come. Same result like iPhone. Yes? If even though they see price increase, still they'll go and buy. Same thing. Some people will still come here. But guys, what do you think now? What will happen to us? Our gross profit will drop. Gross profit will drop. Gross profit amount will drop. Why? Because only half the students will come, right? But still, people are coming. They will pay a higher price. As a result, what do you think will happen to our GPM? Stay the same. Constant. Increase. GPM will increase, guys. For the same product, right? Let's say we are selling the same product at a higher selling price. Still, one customer will come and buy. Right? Earlier we were selling like many, but now only one customer came and purchased it. As long as that person comes and purchases, what will happen? For every dollar of sales, our GPM, our gross profit is high. The thing is, guys, gross profit margin is calculating an average. What is average? For every dollar of net sales, right? Average, right? So that means that average will increase, but GPM actually doesn't calculate what happens to the gross profit. Make sense? Yeah. That's the story. Remember, guys, there is a VC question. What I just explained it to you is VC question. This one, what I have circled here, is a VC question. Right? So this form, this way, this simpler explanation you won't find in the textbook as well. This one. So I simplified as much as possible. Right? So see, increase in selling price, you can include GPM, subject to gross profit amount increases or remains constant. If GPE, gross profit amount, dollar value, decreases due to an increase in selling price, it is not an improvement. It is not recommended, increase in selling price. Yeah. For iPhones, no problem. They can keep on increasing the price. Still customers will buy. Yes, no. Same number of people still will come. Majority of the people will come, right, and they'll buy. But for price conscious products, they have to be careful. Competitive products, they have to be careful. Okay, right. Then the other methods in improving GPM is decrease cost of sales, decrease other buying expenses. Yeah. Basically, guys, that's it for the theory. For GPM. Okay. We'll do a question, yes? Any questions from this sir? So as I told you guys, that's a VC question. Okay? So now we are doing VC questions, yes?
You use gross profit, right? Not adjusted gross profit.
Gross profit only, yeah. Not adjusted gross profit, guys, okay? Just gross profit.
How many decimal places do we do it through? One.
Percentages, guys, you can round it to the whole number.
I still don't get the whole decrease in gross profit or increase in gross profit margin.
You can, sorry?
I still don't get the whole increase in gross profit margin, decrease in gross profit.
Decreasing gross profit. Yeah, you know the reason. Alright, so simply, let's say we are selling what? Say we are selling textbook. So imagine we are selling, to make it simple, let's say we are selling 10. Okay, in 1 month we are selling 10. So what, let's say the selling price is, assume the selling price is 50. Okay, selling price is 50 and COGS is 40. Right? So what happens is, if you are selling 10, how much is our gross profit? 100. Right? So 10 times 10 is 100. Right? Then if you calculate the gross profit margin, how much is it? 100 divided by 5,000, yes? Yeah, 100 divided by basically 5,000, right? Which is giving us, what is the net profit, gross profit margin? 2%, right? So basically, is it 2%? No, I think calculation mistake. No, 50 times 10. No, 500 actually. 500. Yeah, which is 20%. Right? Then, okay. Next month, let's say we want to increase the gross profit margin. You double the selling price. When you double the selling price, what will happen? So basically, we will make how much? From every, we will make, we will make from one item, we'll make $60, right? $60 of gross profit.
Yeah, because COGS stay the same.
COGS is the same. And on the other hand, as a result of doubling the selling price, what happened? Only one customer came and purchased. So that means what happened? Earlier our gross profit was 100. Now it is 60. And if you calculated the GPM, what will happen? It will be 60 divided by 100, which is 60%. So see, we basically improved our GPM by 3 times. But what happened? Our gross profit dropped.
So how would you write that out?
Yeah, that's the thing. That's what I have given, right? As long GPM can be improved by increasing selling price, as long as it increases the gross profit amount or remains constant. But if should the GPA drops, then it is not recommended. Make sense?
Yeah.
That's the simplest format that I can put.
So
Yeah. Don't worry about the theory, I'll help you. But basically, that's the concept. Okay, guys? Right, did you calculate the GPM? Yeah, how much? GPM? 63%. Net profit? 38%. Okay. All right. Okay, shall we write it, guys? Yeah, you want me to define the GPM or you okay? You guys are okay, yep. Right, then Punara, did you get the same answers?
Yeah.
GPM and NPM? Right, always, as I said, get used to write the formulas. Okay, part C, guys. Suggest 2 strategies the owner could adopt to improve gross profit margin. What do you say?
Decrease cost of sales.
Decrease cost of sales, yes.
Increase other buying expenses.
Increase selling price.
Decrease other buying expenses.
Decrease other buying expenses. Very good. There are only 3 methods, yeah, but they're asking only 2. We'll write them. Okay, so that's how you can write it, guys, if you are going to increase the selling price, okay? As long as the gross profit doesn't deteriorate. Right, part D, guys, explain how increasing selling prices could lead to an increase in gross profit margin but a decrease in gross profit. Exactly the thing that we were talking, yes? Yeah, so this is how you can write it. Yeah, then suggest 2 strategies owner could adopt to improve adjusted gross profit without changing gross profit margin. Yep, without changing gross profit margin means, guys, what do you have to do?
Decrease inventory loss.
Decreasing inventory loss. How can you decrease the inventory loss?
Include physical barriers.
Yes.
Or train staff to be more careful with inventory to reduce
Yes.
risk of inventory damage.
Correct. Right, you have to say that one, right? So, yeah, if you just say decrease inventory loss, that's not correct. You have to give the strategies, right? How to decrease the cost of, inventory losses. First one is improve. Enough? Or shall we do more? Huh? You are tired? Why you went to school today?
No, I wasn't sitting today.
Huh?
Sitting.
Ah. Enough?
And when do we start practice test?
Practice test next month.
So is that like, because today's the last day of September, so is it October or November?
October. Do you want any practice test or shall we do straight away? Test?
Will you send us?
Come in?
Can you maybe upload it?
Ah, okay.
Some practice.
Yeah, you want us to do in the class or practice? Yes?
I think we do